For more on the move in rates, let's bring in Subadra Rajappa, Societe Generale's head of research. I wanted to get your title right. Subadra, great to see you.
Great to see you, too.
So where are rates heading at this point?
We're definitely in the low end of the range. I think it'll be interesting, especially today. We broke through that 4% level, which I'm watching. For what reason is the important question, right? Because in some respects, as you guys were discussing earlier, you're seeing equities perform well, but it's been volatile in the last 2 or 3 sessions. Gold is rising quite dramatically. So there is that safe haven bid. If investors are flocking to treasuries because they're concerned about the broader macroeconomic backdrop, then that's a very different signal than if it was just a buy everything rally where they're buying equities, they're buying gold, they're buying bonds, and there's just a lot of cash in the system. Right.
I wanted to touch on this because stocks don't seem to care about this, and a lot of investors seem to want to look through it. But the impact of the government shutdown, a shutdown of this length, Subadra, at what point do you start getting concerned that this is actually impacting the economy and therefore the markets that you track?
I'm concerned now. I thought that the October 15th deadline would be when you would get some sort of a deal, because that's when the payments go out to the military. But we've found a workaround. So this looks like it's going to go on for a lot longer than people had anticipated, just because people are not coming, both sides are not coming together to reach some sort of an agreement. So that, to me, is a concern, because the longer it drags on, the impact on GDP is going to be somewhere between 0.1 to 0.2% per week. So that just kind of adds up. A lot of that you get back when the workers are back in their jobs, but it's still kind of an uncertain time.
So let me ask you about the dollar and the strength in bonds. I mean, the dollar's been weaker. Would it have been even more weak when you see this sort of, there seems to be a bid for bonds?
So I would say that the dollar versus bonds move is mostly on the back of Powell, right? I mean, we got confirmation today saying that the Fed is on track to cut rates maybe once or twice this year. I think October is very much priced in, and it's going to be delivered. And we have to see if they do continue to cut nearly 5 times more by the end of next year. You're looking at the terminal Fed funds rate going below what the Fed has at its long-run neutral rate. So that's very, very accommodative policy. So in some respects, that should mean a weaker dollar.
Gold move is not a bunch of people going to Costco and buying a couple bars. There's something else going on here. Yep. What do you think the gold market's trying to tell us?
There's a momentum trade there as well. I think that there's just, like I was mentioning earlier, there's a lot of cash on the sidelines. There's over $7 trillion in money market fund instruments. So people are trying to find places to park their cash in. Equity markets are at all-time highs. So the valuations there might start getting some investors concerned. They're putting their money into bonds. They're putting their money into global equities. So I think gold is one of many avenues investors are looking to put their money to work.
Subadra, so let's go further with that. I mean, I read your notes. It sounds like you think investors should be allocating to money markets and cash. And that's interesting, because the equity market participants will say, hey, I see $3.9 trillion in money markets that are coming to us as rates come down. Do you think it's that may be the case, it may not be the case? Do you think the opposite of that?
I think the opposite of that, only because of the fact that money fund AUMs have been going up. As money has been flowing into the equity market, and equities have been making all-time highs. So the idea was that, a year or two ago, that when the money starts, when the equity market starts to perform after the Fed's done, hiking, and when they start cutting rates, you should see money flow away from money market funds into equities. And that's not happening.